Yes, so I want us to start, and basically we have said that make sure your video is off. Make sure your video is off. Make sure your video is off. I can see already your video is on. Make sure your video is off. Yes, thank you. Yes. So I want us to basically go through those particular questions. If you check on that handout which I've shared with you, there are a number of questions, I think like 4 questions. And there is a question coming from the topic of leases. That is question number 3. We also have question number 4. And this is basically a question which comes from the topic of deferred taxes. And then if you check on question number 1 and also question number 2, these 2 questions basically come from the topic of a financial instrument, specifically the compound financial instrument. So therefore, in today's session, I want us to revise on those 3 areas. Number 1, we're going to look on something to do with CFI. CFI, recall that these are compound financial instruments. And actually, these are a concept you covered in the topic of financial instruments. Then also, we're going to revise on something to do with the leases, how the leases are accounted for in accordance with IFRS 16. And also, then from there, we do a question on deferred tax, and actually this is something which is governed by IS 12. Remember CFI, this one is governed by IFRS 9 and also International Accounting Standard number 32. So therefore, those are the 3 areas I want us to revise today. And basically, I've said that my name is 𝗟𝗲𝘀𝗀𝗀 for those who are joining us for this free session. My name is 𝗟𝗲𝘀𝗀𝗀𝗀, and this is a free class coming to you courtesy of Focus Online College. So if you check on question number 1 and basically question number 2, you'll basically realize that those 2 questions are the same. Those 2 questions are the same. And therefore, what I want us to do question number 2, because I think that is the more comprehensive question. And then I'll basically give question number 1 as an assignment. So question number 1, question number 2, they are on compound financial instrument. I want us to do question number what? Question number 2, and then question number 1, I'll give it as an assignment. Sasa? Yes. So let's go straight to question number 2. Yes, so we got straight to question number 2. John, I think I've already shared those questions in the class WhatsApp group. I've already shared those particular questions in the class WhatsApp group, John. So the questions are already there in the class WhatsApp group. So check them there. The questions are already shared in the class WhatsApp group. Sasa, yes. So let's go straight to question number 2. And basically in this particular question, what are we told? I've said that is basically a question coming from this concept of a compound financial instrument. So we are told on 1st of May 2022, a party limited issued 10.5% shillings 36 million convertible notes at par. They were, or basically we are told that there were no issue cost. So basically what that means that when these particular convertible notes were issued by our company, there was no any cost which was incurred by the company. And then you're told that the interest is payable on 30th of April each year. And then you're told that the loan notes would be redeemed, or actually would be redeemable at par on 1st of May 2026, or converted into ordinary shares at the holder's option on the basis of 40 shares, or basically ordinary shares for shillings 100 of the loan notes. And then in this case, we are told that a similar loan notes issued by Safari Limited without the conversion option attract an interest rate of 13.5% per annum. And then what are we required to do in relation to this particular question here? We are told with suitable computations, analyze the accounting treatment of the above financial instrument in the financial statement of Party Limited for the year which ended 30th of April 2022, 2023, 2024, and basically 2025. 25. Now, the first thing which we need to note, as far as this particular question is concerned, we are told that this company, which is called Party Limited, issued something called the convertible what? Issued something called the convertible roll note. Convertible roll note. So in this case, anytime you see the word convertible, what you need to remember very fast is that this is what? This is a compound financial instrument. Now, in this case, we say that when talk about a compound financial instrument, this is basically a financial instrument which contains both equity and liability what? Components. So therefore, this is a compound financial, or this is a financial instrument which basically contains the equity and also something called the liability what? The liability component. The liability what? Component. In this case, the reason why we say that this particular financial instrument, which are convertible, they contain both the equity and liability component, is because if, for example, you invest as an investor, if, for example, you invest in securities which are convertible, basically in this case, we say that you have the right to convert them into ordinary shares of what? Of the company. So that right to convert them into ordinary shares of the company, so that one itself is called what? Is called equity. So equity is whereby you have acquired the ordinary shares of the company, or basically you have the right to acquire the ordinary shares of the company in what? In the future. Now, on the other hand, we say that the company which has issued this particular convertible note, basically that company has an obligation to pay something called the interest and basically something called the principal what? Amount, of which we say that that obligation of the company to pay interest and the principal amount, that one is a liability. That one is what? Is a liability. So therefore, anytime you come across a question and you're told a company has issued some security, for example, debentures which are convertible, maybe bonds which are convertible, loan stock or basically loan notes which are basically convertible, what you need to remember very fast is that that is a compound financial instrument. And actually what we say is that anytime the company has issued this compound financial instrument, according to this particular standard here, the International Accounting Standard number 32, a company is required to split the two components. Which are those two components? The equity component and basically what is called the liability what? The liability component. The liability what? Component, of which in this case we say for the company to be able to split these two components, the equity component and the liability component, we said there are two steps which are supposed to be followed. Step number one is that we compute the liability component, of which we said the liability component, this one is equal to the present value of the annual interest to be paid by the company and also the principal amount. So how much amount is supposed to be paid by the company to the holder of this particular convertible security? So we discount that. Basically, to discount is all about getting the present value. So we get the present value of the annual interest and the present value of the principal amount. That will give us something called the liability component. So that is step number one. Once we have computed that liability component, step number two, we said we proceed and basically compute something called the equity component. Equity component is computed by taking the amount of money which was received by the company, which is called the sales proceeds, minus the liability what? Component. So therefore, that is the requirement of IAS 32 as far as the compound financial instrument are what? Are concerned. So having done, then we can basically go straight to our questions here. That is the question number 2 of the handout which I've shared with you there. Maybe for those who are joining, we are doing question number 2. If you have just joined, and I've said I've shared those particular questions in the chat box. So if you go to the chat box, you'll be able to see those particular questions there. John, I think I've shared these particular questions in the chat box, and I've also shared them in the class WhatsApp group. They are not working. Who is also experiencing the same problem? Charles, are you able to access those particular questions? John, what is the problem? Eunice, are those particular questions okay? Okay, sawa. So, okay, sawa. So let's proceed. So in this particular question, what you have said is that this particular convertible roll notes which were issued by our company, the convertible roll notes, which were issued by our company, the first thing which you needed to appreciate is that, or basically to know, is that this is a compound financial instrument. So being a compound financial instrument, we have said on the date of the issue, this company needed to split the two components, the liability component and the equity component. And always we start by computing the liability component. We always start by computing the liability component, and actually we compute this one on the date of the issue. Now, if you check on the information we have in paragraph 1, we are told on 1st of May 2022, a party limited issued 10.5%, that is 6 million convertible notes. So means that these particular convertible notes were issued on which date? They were issued on 1st of May 2022. So that is basically the date we need to compute the liability component. So this one we have said is computed by discounting two items, discounting the annual interest and also discounting the principal amount. So therefore, this one is equal to the present value of the annual interest, and then to this we add the present value of the principal amount. Remember, in this case, the principal amount, this is the amount which is supposed to be paid by the company on redemption. The amount to be paid by our company on what? On redemption. So let's start by computing the annual interest. The annual interest, this one is the same with the interest per annum. So how much interest is supposed to be paid by our company on annual basis? Now this one is computed by taking the coupon interest rate, and then we multiply that with something called the par or the nominal, or basically the face value of the compound financial instrument. That is basically the formula which we use to compute the interest to be paid by our company on annual basis. Because if you check on this particular question here, you'll basically realize that we have two types of, or actually we have two interest rates. We have the first interest rate, which is given in the first sentence, 10.5. And then if you check on the last paragraph, we have another interest rate, which is 13.5. I'm told my board is having a problem. I can see someone is complaining about Mwalimu's board. I hope my video is there. Is clear. Is my video clear? Yes, I'm told my video is clear. If you're having a problem with the video, maybe you can just exit, then rejoin, exit, then rejoin, exit, then rejoin. I'm told my video is very much clear. So if you have a problem, exit, then rejoin. Sasa, yes. Now, in this case, what I've said is that to compute the interest to be paid by our company here on annual basis, we basically have to take the coupon interest rate. We multiply that with the par value, the nominal or the face value. Now, I'm saying if you check on the information given in this question, we have two interest rates. Now, in the first sentence, or actually the first paragraph, the first sentence, we have 10.5. We have 10.5%. And then in paragraph 2, we have another interest rate, which is 13.5. Now, 13.5, which are given in paragraph 2, if you check, we are told that a similar loan notes without a conversion option attracts an interest rate of 13.5. Now, this one, we refer to it as the effective interest rate. In other terms, we refer to this as the market interest rate. Now, the market interest rate. Now, this particular rate here is used for discounting. Is used for what? For discounting. So in this case, remember, whenever you are discounting, whenever you're getting the present values, you must have an interest rate. So this is the interest rate which you are going to use for discounting. But whatever you have here, that is 10.5, which basically comes before the name of our compound financial instrument, because you are told these compound financial instruments, they are 10.5. This is what we refer to the coupon interest rate. So therefore, in that case, you must be able to differentiate between the coupon interest rate and the effective interest rate. So this is our coupon interest rate, and that is basically what we use here to compute what? To compute the interest to be paid on annual basis. So we will take 10.5, and then we multiply that with the face or the par or the nominal value of this compound financial instrument. I think That is also given in paragraph 1, sentence 1. We are told on 1st of May 2022, Party Limited issued 10.5% 36 million convertible notes at par. Now, in this case, this amount of 36 million, this is the par value. It can also be known as the face value. It can also be known as what? The nominal value. So therefore, the nominal, the par, or the face value is basically 36 million. 36 million. So can we compute this particular interest to be paid on annual basis? Give me the interest here to be paid on annual basis by our company. So this will give us an amount of how much? 10.5% of 36 million. Of 36 million. I'm told this one will give us 3,780,000. 780,000. And this one is per annum. This one is per what? Per annum. So then from there, having that, we also need to determine the principal amount. In this case, when we talk about the principal amount, this is basically the amount payable on redemption. The amount payable on what? On redemption. On redemption. On what? Redemption. And actually, we say that this particular amount payable on redemption, this one is always equal to the par, the nominal, or the face value, unless told otherwise. Unless told what? Told otherwise. So therefore, this one we said is equal to the par value, unless told otherwise. Unless told otherwise. Unless told otherwise. So can we check what you're given or what you're told in our question? So let's go back to paragraph 1. I think there is some information which you're given in relation to that. So in the first paragraph, sentence 2, you're told there was no issue cost. And then you're told the interest is payable in arrears at the end of each year. And then you're told the loan notes would be redeemable. That is our interest. Would be redeemable or at par. Would it be redeemable at par on 1st of May 2026, or basically can be converted into ordinary shares. So meaning that the amount to be paid on the redemption will be equal to the par, the nominal, or basically what? The face value. And in our case, who can recall how much is the, or what is the par? The par or the face value of this compound financial instrument? Who can be able to recall that particular amount? The par, the nominal, or the face value of our compound financial instrument? Who can be able to recall that amount? That amount we have said is 36 million. 36 what? Million. So therefore, the amount to be paid on redemption, this one will be equal to 36 what? To 36 million. To 36 what? Million. So therefore, having that, we can be able to proceed and basically we compute the liability component on the date of the issue. So we just need to discount this amount here, and then we discount the annual what? Interest. And for you to be able to understand how we discount this particular annual interest and the principal amount, maybe first of all, we need to go back to our question. Basically, we know what was the life of this compound financial instrument. What was the life of this compound financial instrument? So if you check on the date they were issued on 1st of May 2022, and then we are told they will be redeemed on which date? They will be redeemed on which date? As per the information you have in paragraph 1, sentence number 3, we are told they will be redeemed on 1st of May 2026. 1st of May 2026. So in this case, how many years do we have between these two dates? How many years do we have between those two dates? How many years do we have between those two dates? We said that make sure your video is off. You make sure your video is off. Gibson, yes, thank you. Your video should be off. Yes, so in this case, how many years do we have between those two dates? So automatically the first year here will end on 30th of April 2023. The other year, 30th of April 2024. The other year, 30th of April 2025. The other year, 30th of April 2026. So basically it means that here we have 4 years. We have 1, 2, 3, 4. So basically we have 4 years. So it basically means that our company here on annual basis will be required to pay this particular amount. So this particular amount, as per the information we have in paragraph 1, we are told is payable at the end of each year. So at the end of each year, the company will be required to pay 3.78 million. That is payable in year 1, at the end of year 1, at the end of year 2, at the end of year 3, and also at the end of year 4. And therefore we say that this particular amount here, this one is an annuity. We know how to discount an annuity. So therefore this one is an annuity. And then at the end of 2026, that is at the end of the 4th year, the company will be required to redeem this compound financial instrument by paying back an amount of 36 million. So therefore this 36 million is payable at the end of the 4th year. Therefore, this particular amount is what? Is a lump sum. Is what? Is a lump sum. So therefore, let's proceed and basically we discount these particular two amounts. So we start by discounting this annual interest, which is the 3,780,000. And basically we multiply that with something called the present value, interest factor of annuity. Remember, in this case, I've said for discounting, we are going to use the interest rate which is given in the last paragraph. In the last paragraph of our question. In the last paragraph, we are given interest rate of 13.5. That is what we use for discounting. 13.5, and basically for 4 years. Because this particular amount will be paid by the company in the next 4 years. So that is how we discount that annual interest. And then we also discount this principal amount. That is 6 million. That is 6 million. We multiply that with the present value interest factor at the rate of 13.5%, and basically for 4 years. For 4 what? For 4 years. So let's proceed and basically we discount this. So we start with the annual interest. So we need to record the formula for this one. The formula which we use here is the 1 is basically what? Is 1 minus 1 plus R. Our R in this case is what? Our R is 13.5. So it will be 1 plus 0.13.5, which will be 1.135 raised to power negative n. Our n here is 4. We raise that to power negative n, and then we divide all that with R. Right? So 0.135. So I hope you can be able to record this formula for discounting an annuity. This is the formula we have used there. That is the formula we have used there. Because we say that in financial reporting, you must be able to record these particular formulas here, because you'll not be given those present value interest factor tables like in FM. So you must remember this particular formula. So then we need to add the present value of the principal amount. The principal amount is 36 million. 36 million. 36 million. And then this one is a lump sum. This one is a lump sum. How do we discount a lump sum? We discount a lump sum using this particular formula here. 1 plus R raised to power negative 1. Raised to power negative n. So therefore this one would be 1.135 raised to power negative 4. So can we get the final value there? Which now will be the liability component on the date of the issue. So let's start by discounting the interest, the annual interest. So we have 1.135. We raise that to power negative n. Then 1 minus answer divided by 0.135. And basically in this case here, I'm getting an amount of 2,994,038. Okay, sorry. So I think that is the present value interest factor of annuity. I need to multiply that with 37,80,000. Yes, and basically this one will give us 11,127,000. Maybe to the nearest whole number, 688. I hope that is what you're getting. Yes. Okay. So then we discount the principal amount. We have 1.135 raised to power negative n times what? Times 36 million. And in that case, I'm getting 21,692 972 to the nearest whole number. To the nearest whole number. To the nearest whole number. I hope that is what you're getting. Yes. Then let's add the two values there. Let's add the two values. Let's add the two values. And in this case, I'm getting 32, 820, 820, 660, 660. Yes, so that is basically how we compute the liability component. Having computed this liability component, the next thing we need to do is to compute the equity component. We need to proceed and basically compute what? The equity component. So the equity component, recall, is also computed on the same date, the date of the issue, that is on 1st of May, 2022. How do we compute this liability? Not the liability, rather the equity component. This one is computed by taking the total proceeds. The total proceeds. So the total proceeds refers to the total amount of money which was received by the company. The amount of money which was received by what? By the company. So in this case, we need to go back to the information we have in the first paragraph, and basically we identify how much amount was received by the company from issuing these convertible loan notes. So in the first sentence, we are told on 1st of May 2022, Party Limited issued 10.5%, that is 6 million convertible loan notes at par. They were issued at par. So if they were issued at par, we know the par value is 36 million. So this is the amount of money which was received. But also in the other sentence, we are told there was no issue cost. For example, in this case, if there was some issue cost, this is basically the cost which is incurred by the company. This is the cost incurred by the company in issuing this compound financial instrument. So such issue cost should always be deducted from the amount which was received. So if there was an issue cost, for you to get the net amount of money which was received by the company, less than from the sales proceeds, or basically from the total proceeds. In our case, we don't have issue cost. So therefore, the amount of money which was received is 36. So having this, then we proceed and we less the liability component. The liability component which you have computed in step number 1. Remember, the liability component which you have computed is what we have here, and that is 32, 820, 660. So the difference is basically the equity component. The difference is the equity what? Is the equity component. So how much is our equity component here? How much is our equity component? The difference between those two values. Yes, the equity component should be 3179, 340. 300 and what? And 40. Then what you have to remember, we say that the value for the equity component is one remain the same. So the value for the equity component for the next 4 years, that one will not change. But this particular liability component, this one, we say that this one has to be amortized. This one has to be what? To be amortized. Remember, in this case, we say to amortize a liability. This is to gradually write off a liability, because this amount, 32, 826, 60, this represent what our company is expected to pay for the next 4 years. So at the end of the 4th year, the value for that liability component should be 0, because this one is like a loan to the company. We should gradually write it off in the next 4 years. So therefore, let's amortize this one, because if you check on the question, what the examiner was requiring is we prepare financial statement extract, the income statement extract, the statement of financial position extract, basically to show what was supposed to be recognized in the income statement and what was supposed to be recognized in the statement of financial position. For us to be able to do that, we must first of all amortize that liability. So therefore, we prepare the amortization schedule. The amortization schedule, basically we prepare this one to do what? To amortize our liability. This one is the same. We prepare this in the same way, just like how you prepare the loan amortization schedule, or how you prepare a lease amortization schedule. So we should have a column here for our 4 years. So remember, the first year here was supposed to end on, I think, 30th of April. Though if we go to the requirement, we are given those particular dates. If we go to the requirement of our question, yes, because we are required to do what? We are required to, using suitable computations to analyze the accounting treatment of the above financial instrument in the financial statement of party for the 4 years. The first year is 30th of April 2022. The other year added on that year of April 2023, that year of April 2024, that year of April 2025, yes, and that year, yes, that year of April 2025. Yes, should that be the last year? No. Let's also include because how many years do we have here? Yes, these are basically, these are how many years? No, the first year should end on this date, 2023, sorry. 2024, 2025, and basically 2026, because you can see when the first year started, 1st of May. So the first year will end on that year of April 2023. Yes, so those are basically 4 years. Then from there, the next column here will be for the liability. For the liability at the start of the year. The liability at the start of the year, and that is what we have here. The next column here will be for the interest expense. And this interest is also computed using which rate? The effective interest rate. The effective interest rate, remember, is 13.5%. The next column will basically for the cash paid. For the cash paid. And the cash to be paid is what we have here in this particular document here. So this is the amount of money to be paid by our company on an annual basis. And then finally, we have the liability at the end of the year. The liability at the end of what? Of the year. So let's work out this. So we start with the interest at the start of year 1, and that is the amount we have here. We have there, which is basically 32. Now, can we work with these particular values to the nearest 1,000 of shillings? Let's work with these particular values to the nearest 1,000 of shillings, because I think those figures are too huge. Yes, so this one to the nearest 1,000 of shillings should be 32,821 to the nearest 1,000 of shillings. And then this one to the nearest 1,000 of shillings will be 3178 to the nearest what? 1,000 of shillings, because I think those figures are too huge. So mean that our values here will be 1,000 of shillings, in 1,000 of shillings, in 1,000 of shillings, in 1,000 of shillings, yes, in 1,000 of shillings, like that. So for the first year, which ended 30th of April 2025, we start with this particular amount here, 821. And then from there, we compute the interest. So the interest will be 13.5% of this. So give me the interest as 13.5% of this particular value here. That will give us what? That will give us what? 13.5% of 32,821. 821. What are you getting? I'm given 4431. 44 to the nearest whole number. To the nearest whole number. To the nearest whole number. Yes. And then from there, we need to determine the cash which was paid. Now, the cash which was paid, I've said, is what we have here. For example, in the first year, our company paid this. In year 2, the company will pay that. The other year, yes. So let's have those particular amounts here. In fact, you can have the cash to be paid for the next 4 years. So that is 780. Here, that is 780. That is 780. And then that is 780. Then in this case, we said we also need to check when will the principal amount be paid. Will it be paid at the end of the 4th year or in the following day, as per the information we have in paragraph 2? In paragraph 1, actually. Paragraph 1, this particular principal amount of 36 million, when is it supposed to be paid? Yes, you can see as per our question here, this one will be paid on 1st of May 2026. So mean that as at the end of the 4th year here, that amount will not have been paid. And that means that once we have prepared this amortization schedule, we should have a balance there of how much? Of 36 million. So that is that amount of 36 will be paid immediately after the end of the 4th year. Yes. So don't include it here, because as at the end of the 4th year, it will not have been paid. So therefore, let's move and we compute the liability. So how do we compute this particular liability? We said we take the liability at the start, this one. We add interest. This is our interest. We can refer to that as B, and then we minus the cash paid. So therefore, to compute this one, we take A plus B minus what? Minus C. That is how we compute the liability. So let's work out that for the first year. 32,821 plus interest 4431 minus the cash paid 3780. So this one should be deducted. That one should be deducted there. And what are you getting? 33,472. So that will be the opening balance in year 2, 33,742. And then we compute interest as 13.5% of the liability at the start. We get 15% of this. Not 15, 13.5. 13.5% of that particular amount. And what are you getting? Yes, I'm given 4519. 4519. Then we compute the liability at the end of year 2, which will be equal to this plus this minus that. And that will give us what? What will be the liability there? What will be the liability? Yes, 34 to 11. Then that will be the opening balance in year 3, 34 to 11. And then we compute the interest. The interest will be 13.5% of this. Yes, 4618, 4618, 4618, 4618. And then we compute what? We compute the liability at the end of that year, which will be equal to this plus this, 4618 minus the cash which was paid. Minus the cash which was paid, 35,049. So that will be the opening balance here, 35,049. And then we compute the interest. The interest, 13.5%, which will give us 4732. 4732. Then, once you compute the liability at the end of year 4, you should get a figure which is almost close to 36. You may not necessarily get 36 because of the aspect of rounding off, but you should get a figure. Yes, I'm told the figure there should be what? The figure there will be 36,001. So the reason why you're not getting exactly 36 is because of rounding off. Now, we are basically done here. We are basically done. Someone can say, I can see someone saying Mwalimu's video is not clear. Someone having a problem with my video? Huh? I'm told my video is very much okay. I'm told my video is very much okay. I'm told my video is very much okay. So if you have a problem with the video, maybe you can try to exit, then rejoin. Exit, then rejoin. You see whether there will be some improvement. Sasa? Yes. I think now we are almost done. What we need to do here is we prepare financial statement extract. Basically, we said to prepare financial statement extract, we want to demonstrate what was supposed to be recognized in the income statement as far as this financial instrument is concerned, and what was supposed to be recognized in the statement of financial position. So let's do that. Let's do that. So we will start by preparing the income statement extract. We will start by preparing the income statement extract, which can also be known as a statement of financial position. Sorry, the statement of profit or loss, that is. The income statement, which can also be known as the statement of profit or loss. Remember, this is an extract. This is an extract. An extract we said is part of, because we know in preparing an income statement, basically, we must have information about what? We must have information about the sales, the expenses, and so on, and so on. So, but in this case, we don't have all those items. So we are preparing part of the income statement, basically to demonstrate what was supposed to be recognized here. So we are preparing this for 4 years. The first year ended 30th of April, 2025. That is 20. This should be 20 what? 2022, sorry. 2022 or 2023? 2023. That is when the first year ended. Then 30th of April 2024, 30th of April 2025, and 30th of April 2026. Of April 2026. Remember, our values are also in thousands of shillings. Are in thousands of shillings. Are in thousands of shillings. Now, what was supposed to be recognized in the income statement? Now, in the income statement, this particular interest expense, which we have here, this one we said should be recognized as an expense in the income statement. Specifically, we recognize it here as part of the finance cost. As part of the finance what? Cost. So under the expenses, the company was supposed to recognize that interest as part of the finance cost. As part of the finance what cost. The interest for the first year is what we have there, 44.31. For year 2 is 45.19. For year 3 is 46.18. And basically for year 4 is 47.32. So that is what was supposed to be recognized as an expense in the income statement, nothing else. So what about in the statement of financial position? Statement of financial position. Now, in the statement of financial position, we have two items. Two items which are supposed to be recognized here. Two items which are supposed to be recognized here. So first of all, we have the equity component. I think I've seen someone asking, why do we have to compute this one? Remember, that is a requirement that on the date these compound financial instruments were issued, the company must split the two components, must determine the value for the two components, the liability component, the equity component. Now, also this equity component, we recognize it here as a component of equity. Remember what we record at the equity, or what is equity? Equity is the share capital and reserves. So, of which you have said that the value for the equity component will not change. We prepare this basically for the 4 years, 2023, 2024, 2025, and basically 2026. So, and also recall our values are in thousands of shillings. Are in thousands of shillings here. Yes, they are in thousands of shillings. So the first thing, or the first item we recognize here is basically this equity component. Equity component, of which you're saying equity component is recognized as an item of equity. So where we record share capital and reserves, that's where we recognize this item here. And we refer specifically to it as equity component. Equity component, a component of what? Equity component of a convertible row notes. I hope that is the specific name for our financial instrument. Yes, so it's row notes, equity component of convertible row notes. Row notes. So the value for the equity component is 31.78, and basically we are saying that this one will not change over the period of 4 years. This one does not change. That one does not do what? Change. And then from the amortization schedule, which you have prepared here, so this particular value which we have there, the liability, at the end of each year, that one should be recognized here as part of the liability. As part of what? Of the liability. Of which we said, don't specify whether this is a current or basically non-current, because part of that liability, part of it is non-current, part of it is is current. Don't specify, just say it is a liability. So under the liability, our company will recognize something called the liability component of the convertible row notes. The convertible row notes. So the value of the liability at the end of year 1 is what we have there, 33,472. Then in year 2, 34,211. Year 3, we have 35,049. And basically year 4, we have how much? We have 36. We have what? 36. So therefore, for you to be able to earn those particular marks which were allocated in that question, I hope you can see there were significant marks allocated here. significant marks, actually 10 marks. So automatically there should be some marks for computing the liability component there, some marks for computing the equity component, and actually for showing what was supposed to be recognized in the income statement and what was supposed to be recognized in the statement of financial position. Basically, by doing that, you get how many marks? You get 10 marks. Yes. So therefore, that is what was required in relation to that question number 2. Now, if you check on question number 1, you will realize that that question number 1 is the same with question number 2. So therefore, what you do that question number 1 as an assignment. Yes, so that one I'll give it as an assignment is also on compound financial instrument. And I'm told this value here. This one I'm told is around 32 what? 32.79. Okay. Okay, 31.79, this one. Okay, no problem. No problem. You can't lose marks because of that aspect of rounding off. You can't lose some marks because of that. Yes, I don't think you can lose marks for that. So that is it. That is what was required in relation to that question. So therefore, if you happen to come across that question in an examination, so make sure you get all the marks. But I've said what you must be very keen on is the word convertible. Is the word what? Convertible. If you're told the company should convertible debentures, convertible bonds, convertible loan notes, or even convertible loan stock, then what you need to remember very fast is that that is a compound financial instrument. So on the date they were issued, split the two components, the liability component and also the equity component. So once you have computed the liability component, you have to amortize it. And then from them, you can proceed and prepare the financial statement extract. So therefore, make sure you attempt that question number 1 as an assignment. Now, I want us to proceed and look on the other questions here. We have 2 more questions. Maybe I want us to do here. Let's go to question number 3. Is a question on leases. This is also a common area in financial reporting and also AFR. So we got to question number 3 there. Question number 3. I hope you can see that question number 3 there. Yes, so what are we told in that question number 3? Is there any question in relation to what you have done? Any question? Any question in relation to what you have done? Yes, Stella, we are using, there is a handout which I've shared in the class WhatsApp group. Those are the questions we are using. I think I've shared that handout in the class WhatsApp group. Check it in the class WhatsApp group, because I've seen that these particular questions, I've borrowed them from ACCA. Yes, so yes, so what are we told here? Question number 3. So we are told on 1st of December 2020, Pen Limited entered into a contract to lease an item of machinery from a supplier for 4 years. So the terms of the lease were that Pen Limited was required to pay annual rent of 1.55 million in arrears commencing on that year of November 2021. And then you're told the initial direct cost incurred on the lease amounted to 429,570 and were to be paid by Pen Limited. So, and then you're told the machine had a remaining economic useful life of 6 years at the commencement of the lease. And then you're told the lease contract did not contain any purchase option for the lessee. So then you're told the interest rate implicit in the lease was 13%. So, and then in this case, we are told to note that the present value interest factor of annuity, the PVIVA, at 13% for 4 years is 2.97, 447. So what are we required to do here? We are required to analyze the accounting treatment of the above risk transaction in the financial statement of 𝗟𝗏 Limited for the year which ended 30th of November 2021, 2022, 2023, and basically 2024. The marks allocated there were 8 marks. Now, we say that once you have you come across a question for leases, the first thing you need to do is basically to identify, like in this case, 𝗟𝗏 Limited, whether 𝗟𝗏 Limited is the owner of the asset, whether 𝗟𝗏 Limited is the lessor, the owner of the asset, or basically whether 𝗟𝗏 Limited is the lessee. And now what we are told in the first paragraph of our question is that this company, which is called 𝗟𝗏 Limited, basically lists an asset, that is an item of machine, from a supplier. From who? From a supplier. So meaning that 𝗟𝗏 Limited, this is the company which lists the asset, and therefore 𝗟𝗏 Limited is who? Is the lessee. Is the lessee. Remember, in this case, we say that the lessee, this is the entity, this is the party given the right to use the asset. If you are given the right to use an asset, maybe for 3 years, 4 years, you are known as who? The lessee. But now the owner of the asset is the supplier. The supplier is the owner of the asset, and actually we say that the owner of the asset is also called the lessor. It's called who? The lessor. Now, what we say is that once the lessee leases an asset, then he needs to recognize 2 items. Number 1, he needs to recognize something called the lease liability, and number 2, he needs to recognize something called the right of use asset. The lease liability and also the right of use asset. Though we say that there are 2 exemptions in relation to this. There are instances whereby, for example, you can lease an asset, but you're not required to recognize the lease liability and the right of use asset. You need to remember those particular exemptions. Number 1, we said, is whereby the lease is a short-term lease. Is a short-term lease. So in this case, when we talk about a short-term lease, this is whereby you lease an asset for a period of 1 year or less. So in such a case, you're not required to recognize the lease liability. And number 2, you're not required to recognize what? The lease liability. So in this case, what we said here is that if the company, for example, leases an asset for 6 months or even 3 months, so what that company is required to account for is the lease rentals which was paid, which should be recognized as an expense. Which should be recognized as what? As an expense in the income statement. Number 2, we said that the lessee is also exempted from recognizing the right of use asset and the lease liability, where the asset which has been leased, is actually regarded to be of low value. The leased asset is regarded to be of low value. So in this case, we say that IFRS 16 does not specify what an asset of low value means, but basically it has given good examples. So if, for example, you lease maybe an old car or even a personal computer, something like a laptop, so in that case, that asset is regarded to be of low value. So in such case, you are not required to recognize the lease liability and the right of use asset. But we said once the lessee has leased an asset, has been given the right to use an asset, at the inception date, he must recognize the lease liability and the right of use asset. And also we said that the lessee here is not supposed to classify the lease as a finance or operating lease. That is as per IFRS 16. But we said the owner of the asset here, first of all, even before he proceeds to account for the lease, he needs to determine whether the lease is a finance or basically what? Operating. In this case, we talked about the various criteria which can be used by the owner of the asset, the lessor, to determine whether the lease is a finance or what? An operating lease. So therefore, this company here that is 𝗟𝗏 Limited is the lessee. And therefore, at the inception date, at the date when the lease commenced, this company needed to recognize 2 items, the lease liability and the right of use asset. So let's proceed and basically we do that. In this case, we said always we start by computing. The lease liability, but in this case, we have said 𝗟𝗏 Limited. Basically, this company here is the lessee, and therefore, at the inception date, this company should recognize something called the lease liability. And number 2, the company has to recognize something called the right of use the right of use asset, of which these 2 values are computed at the inception date of the lease. So let's start by computing the lease liability. the lease liability. So at the inception date, the inception date is the date when the lease was entered into, the date the lease commenced. And we are given that date in the first sentence, which is 1st December of 2020. And how do we compute the lease liability? The lease liability, we said, is equal to the present value of the minimum lease rentals not paid at the inception date. The present value of the minimum lease rentals not paid at the inception date of the lease. Not paid at the inception date. In other terms, to compute this particular lease liability, what we do is that we discount. We get the present value of the minimum lease rentals, which were not paid at the inception date of the lease. Now, if you go back to the question specifically in paragraph 1, you're told on 1st December 2020, Perry Limited entered into a contract to lease an item of machine from a supplier for 4 years. So therefore, this lease basically is for 4 years, year 1, year 2, year 3, year 4. So therefore, our lease is basically for 4 years. And then we are told that the terms of the lease is that Perry Limited was required to pay an annual rent of 1.55 million in arrears. We say that one is very important when the minimum lease rentals is payable. In this case, we are told it's payable in arrears. In arrears means that this amount is payable at the end of each year. So at the end of the first year, our company was required to pay 1.55 million. At the end of year 2, 1.55 million. At the end of year 3, the same. At the end of year 4, the same. So this particular amount is payable in arrears. It's payable in arrears. So therefore, we need to discount this so that we get there is what? There is liability. So we take 1.55 million, 1.55 million. We multiply that with the present value interest factor of annuity because these are annuities. And then we discount this using something called the interest rate implicit in the lease. And I think that one is given within the last, within paragraph 2, the last sentence. We're told the interest rate implicit in the lease is 13%. 13%, and basically for 4 years. For 4 what? For 4 years. But if you check on the information provided in this question, you'll be able to see we are given this particular value here. Can you see that value in the last paragraph? The present value interest factor at the rate of 13% for 4 years. For 4 years. Can you see that present value interest factor? How much is it? The 𝗙𝗶𝘃 at the rate of 13% for 4 years. You can see that value in the last paragraph of our question. Yes, it's given as 2 point what? It's given as 2.97447. Recall, in case, for example, you're not given this particular value here, I've said we computed using this particular formula here. 1 minus 1 plus R raised to power negative n, we divide that with R. Maybe we can confirm whether we are going to get the same value. Our R is 13%, our n is what? Is 4. Yes, so we have 1 minus 1 point, remember our R is 13%, this would be 1.13 raised to power negative 4, and then we divide that with 0.13. So can you confirm whether we're going to get the same value? Confirm whether we will get the same value by computing that by using our formula 1.13 raised to power negative n, 1 minus answer divided by 0.13. Yes, you can see we are getting the same what? We are getting the same value. So in our case, we are already given this value. So we multiply this with whatever you're given. That is 2.97447. So let's multiply those two values. Multiply those values times 2.97447. And what are you getting here? What are you getting here? Yes, so this one will give us 4610, 4610, 428 point what? 0.5. 0.5. Is that what you're getting? 0.5. Yes, 0.5. So what is this? This is basically the lease liability at the inception date. Now we said that this particular lease liability, even before we proceed to compute the rate of use asset, we said that this one has to be amortized. We do what? We amortize that. So let's first of all, we amortize this, then we proceed and compute the rate of use asset. So to amortize this one, we prepare something called the lease amortization schedule. The lease amortization schedule. And basically this one, we prepare it for how many years? For 4 years. We prepare this for 4 years. For 4 years, that is. So here we need to have a column for the years. The first year, you can see when the financial year of these companies started. First, I think this one should be 1st December. This one should be 1st December. This one should be 1st December. 1st December. So for us to be able to know when the financial year of these companies is ending, we can get that from the requirement. Can we go to the requirement? We are required to analyze the accounting treatment of this lease transaction in the financial statement of Perry for the year which ended 30th November. So the financial of this company is ending 30th November. The first year will end 30th of November 2021. The other year, 30th of November 2022. 30th of November 2023. 30th of November 2024. Remember, our lease is for 4 years. The next column here will be for something called the lease liability at the start. The lease liability at the start. LL is for the lease liability. Then the next column which follows always depends with when the minimum lease rentals are paid. So in our case, the minimum lease rentals are paid in arrears. They are paid at the end of each year. So the next column here will be for the interest. For the interest. And therefore, I hope you can be able to recall, those were my FR students. You can recall there is a question we did in class whereby the minimum lease rentals were payable in advance. And I hope you can remember the next column here was for the minimum lease rentals payable. And then after that, we have what? The interest. So we said the next column, which follows here, depends with when the minimum lease rentals are payable. So if the minimum lease rentals are payable in arrears, after the lease liability at the start, you have the column for interest. And then from there, the amount to be paid. So of which this one will be computed at the rate of 13%. 13%. Then we have a column for the minimum lease rentals, which was paid. And then finally, a column for the lease liability at the end of the year. At the end of what? Of the year. And equally in this question, I think what we need to do, let's also work with our figures to the nearest 1,000 of shillings. We work with our figures to the nearest 1,000 of shillings. To the nearest 1,000 of shillings. This is the minimum lease rentals paid. Our figures, we work with our figures to the nearest 1,000 of shillings. So to the nearest 1,000 of shillings, this one would be equal to 4610. 4610 to the nearest 1,000 of shillings. Is that the case? 4610? 4610 to the nearest 1,000 of shillings? Yes, 4610. 4610. So that is what we are going to start with here, 4610. And then we compute interest. Interest will be 13% of this. So give me the interest. Give me the interest there. The interest. The interest. What are you getting here? The interest. The interest I'm told to the nearest whole number I'm told is 599. 599. And then from there we record the amount of minimum lease rentals which was paid. So we know that this company which leased this machine, Perry Limited, at the end of each year is supposed to pay this amount. So this is the amount to be paid at the end of each year. In fact, we can record that for the next 4 years. So 1550, 1550, and basically year 4, 1550. That is what our company will pay at the end of each year. So to compute the lease liability at the end of the year, remember this is just like a loan. So we take the lease liability at the start, we add the interest, and then we minus what was paid. we minus what was paid. So that we get the lease liability at the end of the year. So the lease liability at the end of year one would be equal to this plus that minus this minus that. And I'm told that one will give us 36.59. That is the figure I'm getting from Hilda. I hope you're getting the same. Yes. So that will be the opening balance here, which is 36.59. Then we compute interest as 13% of this. 13% of this liability. 476. Then we compute the lease liability at the end of year two. And you're getting what? 2. Okay, I don't think that one is correct. So this one will give us 25.85. So that will be the opening balance here. 25.85. Then we compute interest, 13% of this. 336. Yes, then compute the lease liability at the end of the year. So this plus this minus 1550. Minus 1550. Yes, make sure your video is off, Elizabeth. General, make sure your video is off. Yes, Naomi, make sure your video is off. So I'm told this one will give us 1371. Yes, thank you. Thank you, Naomi. And then we compute the opening balance here. Sorry, okay, the opening balance is what we have there, which is 1371. Then we compute interest here. I hope that is the amount of 178. And then once we work out the lease liability there, it should give us 0, though you may get a figure which is insignificant, like 1 or 2. I think here you are getting what? You are getting 1 or -2, yes, because of the concept of rounding off. So, but basically that is now how we amortize that liability. We amortize that what? Liability. Now, having amortized our liability, the next thing we need to do is basically we compute the right of use asset. We compute the right of use what? Asset. And remember, you compute that we compute this right of use asset at the inception date of the lease. So the inception date is 1st of December 2020. That is the inception date. Now, this one we said is computed basically by adding how many values? By adding 3 values. We add 3 values here. Remember, our values here should be 1,000 of shillings. So first of all, we start with the lease liability. The lease liability at the inception date. Remember, the inception date is 1st of December 2020. 1st of December 2020. The lease liability is what we have computed here. This is the lease liability on 1st of December 2020. That is 4610. 4610. And then to this, we said we add something called the payment made at the inception date. Payment made at the inception date. Now we say that this one only applies whereby the minimum lease rentals are payable in advance. So if you check on our question here, the minimum lease rentals are payable in arrears. So meaning that there was no amount which was paid there. So, but if these minimum lease rentals are payable in advance, so the amount which was paid at the start of year one is what we consider here as the payment made at the inception date. So, but in our case, this one is 0. This one is nil. And then to this, we add any initial direct cost. We add initial direct cost, which were incurred at the inception date. Now, if you go back to our question here, I think we have that. We have some initial direct costs which were incurred by our company here. Where do we have that information? We have that information in the first paragraph, the last sentence. We are told initial direct costs incurred on the lease amounted to 429,570 and were basically paid by Perry. This is now the initial direct cost incurred on the at the inception date. And equally, we take that value to the nearest 1,000 of shillings. That one should be around 430. 430 to the nearest 1,000 of shillings, 430. So basically, we add the 2 values and we get something called the right of use asset at the inception date. So this one will give us an amount of how much? we add the two values, is this one will give us 50, 40. 50, 40. That is the right of use asset at the inception date. Right of use asset on 1st of December 2020. Now, we said that this particular right of use asset should be depreciated. Should be depreciated on straight-line basis at the lower of two periods. So this one is depreciated on straight-line basis at the lower of two periods, or basically at the shorter. Let's use the word shorter. At the shorter of two periods. Which are those two periods? Number one, the lease term. The lease term. So the lease term is basically the period of the lease. So in our case, we know this lease was for how many years? Was for 4 years. 4 years. So we take this or something called the remaining economic or the remaining useful life of the asset. And we also have this. So what is the remaining useful or economic life of this asset? From the information we have, in paragraph 2, we are told the machine had a remaining economic useful life of 6 years. 6 years. So out of these two periods, we take the period which is shorter. The period which is shorter is which period? Is this one, 4 years. So therefore, to compute the depreciation per annum, we take the value for the right of use asset, which is 50, 40. We divide that with 4 years. We divide that with 4 years. We divide that with 4 years. That will give us annual depreciation of how much? Will give us annual depreciation of 12 what? 1260. 12 what? 60. Remember that one is per annum. That one is per annum. So I think having that, we can basically now wind up by preparing what the examiner was requiring. The examiner was requiring we demonstrate how this transaction was supposed to be accounted for in the financial statement of Perry. So we demonstrate by preparing the financial statement extract. So I think we can start by preparing the income statement extract and then statement of financial position. So we start with the income statement extract. Income statement extract. Income statement extract, of which this will be the income statement extract basically for the 4 years. For the 4 years, the first year added 30th of November 2021, 30th of November 2022, 30th of November 2023, 30th of November 2024, and then also our values here are in thousands of shillings. Are in thousands of shillings. Now, what was supposed to be recognized in the income statement here? Who can tell us which items do we recognize in the income statement? As far as this transaction is concerned, which items do we recognize in the income statement? Who can be able to remember? Yes, I'm told by General here, one of the items we recognize here is the interest. That is very much correct. This one will be recognized as an expense here. And number 2, I'm told by Mary, we also recognize what? Depreciation. So those are the 2 items which we recognize here, of which those 2 items are items of expenses. These are items of what? Of expenses. We can start with the interest, of which this interest, we recognize it here as part of the finance cost. As part of the finance cost. So for the first year is the 599. Then we have 476. We have 336. And then we have 178. We recognize it here as part of the finance cost. Then we also have the depreciation on the right of use asset, of which this one will be 26. That is 1260 per annum in the next 4 years. So that one does not change. 1260, 1260, 1260, and basically 1260. So then next, we prepare the statement of the financial position extract. Statement of financial position extract. Now, in the statement of financial position extract, I hope you can be able to recall. We recognize like 3 items here, 3 items. But let's first of all have our 4 years here, 30th of November 2021, 2022, 2023, 2024 there. Values are in thousands of shillings. Are in thousands of shillings. Now, here we recognize basically, I think, like 3 items. Number one, we recognize this right of use asset. Now, the right of use asset, we recognize it here as one of the non-current assets. One of the non-current what? Asset. So we will have the right of use asset. The right of use asset, of which this right of use asset, we recognize it here at the net book value. Net book value, remember, the original value of this asset was 50/40, and then it is losing a value of 1260 each year. So how do we compute the net book value at the end of year one? The net book value at the end of year one would be equal to the original value minus depreciation for year one. Then once we go to year two, we take this particular value here, and then we less depreciation for 2 years. In year three, we take that value, 50/40 minus depreciation for how many years? 3 years. And then at the end of year four, our asset will be fully depreciated. Actually here, the net book value for that asset will be 0. But let's start by computing the net book value at the start of year one. 50/40 minus 1260, that one will give us what? Net book value at the end of year one. Yes, so that one would be 3780. And then now in year two, you can take this one and then you less depreciation for year two. Depreciation for year two, you just less 1260. So which will give us what? 2520. And then year three, you take that, less depreciation for year three, still 1260. So which will give us what? 1260. And then at the end of year four, you take 1260 minus depreciation for year four, which is 1260. The net book value will be what? Will be 0. So our asset at the end of year four will be very what? Depreciated. Then from there, this particular lease liability, which we have here, this one, the lease liability at the end of the year, that one we said we recognize it here as a liability, but this particular lease liability is split into 2 components. Part of it we recognize it here as a non-current liability. Part of it we recognize it as part of what? The current liability. So under the non-current liabilities, we will have something called the lease liability. And also under the current liabilities, we will have something called the lease what? The lease liability. So how do we determine the amount to be recognized as a non-current liability in the first year? In the first year, that is 2021, we said the amount we recognize here is a non-current liabiliity. Recall, a non-current liability is a liability payable for a period exceeding 1 year. A current liability is a liability payable within 1 year. So therefore, at the end of year one, we take the lease liability at the end of year two, this one. So that is what we recognize here as a non-current liability, 2585. I hope you can see what I've taken here. So this one. And then at the end of year two, we take the lease liability at the end of year three, that is 1371. At the end of year three here, we take the lease liability at the end of year four, which is basically 0. At the end of 2024, the lease liability in the next year, which is also 0. This is also what? 0. Sasa? Yes. So then how do we determine the amount to be recognized as a current liability? Remember, these are liability payable within 1 year. And actually we said that should be the difference between the lease liability at the end of year one and year two. So can we get this difference here between the lease liability at the end of year one and year two? You can see there is a decrease. That is the amount which was supposed to be, which was paid within 1 year. That decrease. How much is the decrease there? The difference between the lease liability in year one and year two. Year one and year two, what is the difference? Yes, I'm told it's 1074. That is what we recognize as a current liability there. In year two, we do the same. We take the difference between that and that. The lease liability at the end of year two and year three. And that will give us what? That one will give us 1214. 1214. And then at the end of year three, we get the difference between those two values, which is 1371, and then at the end of year 4 should be what? Should be 0. Should be what? 0. So that is basically what we recognize both in the income statement and also the statement of financial position as far as that particular this transaction is what? Is concerned. And actually we said that this is usually what is marked there. So by doing that, you get what? You get 8 marks. Yes, so that is it, that what is required in relation to that question. In relation to that what? Question. So, but we said that if in case, for example, you happen to come across a question whereby the minimum lease rentals are payable in advance. For example, maybe I can just explain that. Assuming in this question, the minimum lease rentals were payable in advance. So remember, the lease remain for the lease will be for 4 years. So if the minimum lease rentals were payable in advance, so that is 1.55 million, which is payable at the start of year 1, the other one at the start of year 2, the other one at the start of year 3, and the other one at the start of year 4. Is there any difference in terms of how we compute the right of use asset? Is there any difference in terms of how we compute the lease liability and how we prepare the amortization schedule? Yes, there is a difference. Because number one, when computing the lease liability, at the inception date, we have said that this one is equal to the present value of the minimum lease rentals which were not paid at the inception date. Not paid at the inception what? Not paid at the inception date. Not paid at the inception date. So the lease liability, therefore, at the inception date will be computed by discounting this, that, and that, because this particular amount here was paid at the inception date. We said an amount which has already been paid does not form part of the liability. Liability is what you are going to pay in the future. So if you have leased an asset, there is an amount you have already paid that is not part of the liability. So therefore, this one does not form part of the liability. When computing the lease liability, we use this amount which were not paid at the inception date. So therefore, the lease liability at the inception date will be equal to 1550,000. We multiply that with the present value interest factor of annuity. Our interest rate remains 13%, but now there will be a change as far as our period is concerned. So what would be our N here? Who can tell us? If that amount of money is payable, this minimum lease rentals is payable in advance, what will be our N? Yes, our N here would be 3. So 1, 2, 3, because we are discounting 3 payments. We are discounting 3 what? 3 payments. Yes, that is the first difference. When computing that lease liability, you only discount those 3 amounts. Yes, so that is the first difference there. Then when it comes to the preparation of the amortization schedule, when preparing the amortization schedule, also there will be some difference. Because that is what I want you to note. That is what the examiner will keep on twisting in this particular question for leases. When computing there is amortization schedule, so that we can amortize this particular lease liability. We should basically have our 4 years. Our 4 years here. The first year ended 30th of November 2021, 30th of November 2022, 30th of November 2023, 30th of November 2024. So the first column here would be for the lease liability at the start. And I think you can we can compute this value here. Compute for me this value. Compute for me this value here. So we have 50,000. So this would give us what? This one would be 1 minus 1.13. Our N here is R. Sorry, is 3, sorry. And then our R is 0.13. So can you compute for me the lease liability here? 1.13. We raise that to power negative 3. 1 minus answer divided by 0.13 times you're getting what? You're getting that is 650. And actually work with this to the nearest, I would actually to the nearest 1,000 of shillings. To the nearest 1,000 of shillings should be 3660, yeah? 3660 to the nearest 1,000 of shillings, eh? Yes. So meaning that if the minimum lease rentals were payable in advance, that should be the lease liability at the inception date. Then I've said in preparation of this, the lease amortization schedule. So the first column here always we start with the lease liability at the start. Then the next column here would be for the minimum lease rentals which was paid, because this particular amount recorded is payable at the start of the year. So even before computing the interest, we first of all deduct this. Then from there next we compute the interest. The interest at the rate of 13%, and then there is liability at the end of the year. There is liability at the end of what? Of the year. So therefore you can see in preparation of this amortization schedule, there is also a difference because we are interchanging these columns. Yes, that is what I want you to note here. So the lease liability at the start of the year here will be 3660. And then first of all, we less the minimum lease rentals, which was paid at the start of year one. So the minimum lease rentals, which was paid at the start of year one, we know is 1550. 1550 because our lease, remember, is for 4 years. So the amount which was paid at the inception date here is 1550. But basically what we say is that this particular amount which was paid at the inception date is not part of this liability. Is not part of this what? Liability. So when preparing the amortization schedule, don't include it here. Though we know that the amount which was paid at the inception date is 1550, but is not part of this lease liability. In fact, this amount which was paid has not been used in the computation of this. So that's why that one should not be included in the amortization schedule. Yes, then from there we compute interest. How do we compute this interest? To compute the interest, we said we take the lease liability at the start, first of all, minus what was paid at the start of the year. And then you compute interest based on the balance. Based on what? The balance. So in our case, taking into account there was no amount which was paid at the inception date. So the interest for that here will be 13% of what? Of 3660. Of 36 what? 3660. And basically that will give us the nearest number, it will give us 476. 476. Then compute the lease liability at the end. The lease liability will be equal to this, to A minus B plus C. So this one will be equal to A minus B plus what? Plus C. Plus C. Plus what? Plus C. So, and that will be equal to how much? This one will be equal to 4136. 4136. So that will be the opening balance here, 4136. And then the amount which was paid at the start of year two is what was paid here, 1550. You less it there, 1550. And then before you even compute interest, you take this minus this amount. Remember, this amount was paid at the start. And when computing interest is always computed at the end. Yes, so you take 4136, first of all, minus what was paid at the start, 1550. And then the difference, which is now 2586, is what you use in computation of interest. Yes. So which will be, that is 336. And then you compute the lease liability at the end of the year, which will be equal to the lease liability at the start, 4136 minus 1550 plus 336. So which will be 2922. Then you do the same. 2922, you less that amount, and then you compute the interest like that. So that is basically the other difference. Then when it comes to the computation of the right of use asset, the right of use asset here, the right of use asset, also there will be some difference because you start with the lease liability at the start, what you have computed here, that is 660. That is 660. And then you add the payment which was made at the inception date. The payment which was made at the inception date is this one, because in this case, the minimum lease rentals are payable in advance. Sasa, yes, then you minus any, sorry, not minus, rather, we add any initial direct cost. And I think the initial direct cost, which was incurred in relation to this lease, which is given within paragraph 1, was 430. Was 430. So you basically add all that. You basically add all that. And therefore you can see there is a huge difference in terms of the values you're getting when the minimum lease rentals is payable in advance and the minimum lease rentals is payable in arrears. Sasa, there is that big difference. Sasa, yes, that is something I need you to note, because that is what the examiner will keep on changing. When the minimum lease rentals are payable, they can be payable in arrears at the end of the year. They can be payable in advance at the start. Sasa, yes. So I think that is it. That is what was required in relation to that question. And because I can see our time is over, maybe I'll see whether I can be able to organize another session, maybe on Monday, because on Monday is still a holiday. I'll be able to see whether I can organize maybe another session. I invite you to attend, maybe on Monday, so that maybe you can finish on the remaining questions there. The question which is remaining there, actually you can attempt it, is a question on deferred taxes. This is also a common area. Is an area which is covered in FR, is an area which is also covered in advanced financial reporting. Yes. So it's a very good question on deferred taxes. So maybe you can just attempt it, and then maybe I'll be able to see whether on Monday we can, or maybe on Sunday we can have maybe another class, so that maybe you do that question, and maybe I'll also try to get more questions from maybe the other common areas, Otherwise, for today, I want us to stop at that point. And thank you for attending today's session. Maybe for those who are attending, those who have not registered with us, and maybe they're attending this free session. I've said my name is 𝗟𝗲𝘀𝗀𝗃, and basically this class, this was a free class courtesy of Focus Online College. In case maybe you want to reach us, you can use that college number 0719 45 11 55. So maybe you can use that number, you get in touch with us, and you can join our ongoing block revision classes. We are charging just 2,000, and this will enable you to join our block revision classes. Otherwise, thank you for attending. Let's stop at that particular point. I'll be able to see whether on Sunday or basically on Monday we are going to have another class. So I'm told on Sunday there is another session. Okay, sawa. So I think we can have another session on Monday, maybe the same time. I think the timing is okay on Monday. Mary, Nancy, is the timing okay? Is the timing okay? And maybe equally, you can also propose to me maybe the areas you feel maybe you can revise on. Maybe those areas which are common. For example, you know those who are doing AFR, you know those areas which are common, like deferred taxes. I think we have revised on leases. That is also a common area. We also have group accounts. Group accounts is also a common area. Yes, I think in fact, like on Monday, we can do that question on deferred taxes, and maybe I try to get another simple question for group accounts, maybe which we can be able to, which we can attempt. Sasa, yes. So cash flow, we can't do cash flow because cash flow is not a common. So for those who are doing AFR, for those who are doing AFR, what is covered there is a group or the consolidated cash flow. But those who are doing AFR financial reporting, you just do a cash flow for a single company. So I think that is not a common area, but I think I can get a question on group accounts, which is the common. Sasa, yes. So let's continue from here on Monday as we continue with our revision. But the normal classes have not changed. Sasa, the normal classes are as per the timetable. For example, tomorrow we have classes and also I think on Tuesday and Thursdays. So the normal classes are not what affected. So these are just additional classes which Mwalimu is organizing. Sasa, yes. So let's stop at that particular point for now. Have a nice day, and also enjoy your Easter holiday. So see you on Sunday. See you on Monday.